Hi, welcome to EBITDA.tv, and today we're talking about penalty protection and how you can penalty protect yourself like a CPA. Now, one of the first things I do when I tax plan is look at how to protect my clients from penalties. And the penalty that I'm specifically looking at is the underpayment of estimated taxes penalty. This penalty is derived from when a taxpayer doesn't pay enough taxes throughout the year. The U.S. tax system is a pay-as-you-go tax system. And what that means is that throughout the year, you should be paying taxes, either through estimated payments or withholdings. Now, those withholdings doesn't have to be from a paycheck. It could be from unemployment compensation. It could be from a Social Security paycheck or your pension. But the main thing is that throughout the year, you're making timely estimated payments or withholdings. The rule is that you either have to pay in 100% of the prior year, which would be 2018, or you have to pay in 90% of the current year taxes. It means that if you just go look at the last year's tax return and see how much total taxes you paid and pay that in, that you will hit one of two thresholds. And if you always pay it in the prior year, you will always have enough paid in. And the reason why is either you paid in less than 90% of the current year, which is the smaller amount you should be paying, or you paid in more than the current year's taxes and you're penalty protected anyways. So it's a simple, easy rule to remember. All you gotta do, look at the prior year and pay in that amount of taxes by the deadline. And that deadline is January 15, 2020. For high income earners, people who have an adjusted gross income of $150,000 or more, or $75,000 if you're married filing separately, has to pay in a little bit more taxes. Rather than paying 100% of the prior year, they have to pay in 110% of the prior year. Or you can always pay in 90% of the current year. So let's talk about this 90% of the current year. There's many times where you might want to actually pay in not based off the prior year, but the current year. Let's say that last year in 2018, you won the lottery, which is awesome. All this money coming in, that's great, and you had to pay taxes on that money. But this year, you didn't win lottery again, right? You don't have this windfall of money coming in. So it no longer makes sense for you to pay 100% of last year's taxes. It'd be way above the amount that you would need to pay in. So you can go ahead and pay in 90% of what the current tax year is and pay far less taxes. Now, the 90% rule. This is for the brave of heart because this will require some actual tax planning on your part. And if you have a business, this becomes way harder to do. If you don't think that you can do this, I recommend go see a tax professional, go see a CPA so that they can do this tax planning for you. If you decide that you want to do this tax planning, great, I'm here for you, and I wish you all the luck. If you have any questions, please feel free to comment them in below, and I'm happy to help. Now, there's a couple other ways that you can eliminate this tax penalty. If you didn't pay any taxes in the prior year, you won't have an underpayment penalty. And that makes sense, right? If you paid in 100% of the prior year, that'd be zero tax. And that would be the smaller of the two thresholds. Or the second one is if you've done such a good job at calculating your current tax year and you only got within $1,000 or less of paying taxes, you won't create this underpayment penalty either. So what's the rule again? Either you pay in 100% of the prior year or you pay in 90% of the current year's tax bill. I always try to shoot for people to go after the 100% of the prior year's tax bill because that is an easy number to go find. You just go get your 1040 from the prior year, look at your total taxes owed, and make sure you pay that amount in by January 15, 2020. Now, if you decide to go for this 90% or more, it's okay if you only want to pay 90%. You don't have to pay the full 100%. But by the time April 15, 2020 comes around, you have to pay the remaining portion of taxes. Even if you do an extension, this does not mean that you have an extension to pay your taxes. No, all an extension is an extension to file your taxes. With that, guys, I wish you all the best of luck. Good luck out there doing tax planning for 2019. If you want to see the written version of this same video, please go to ebitatv.com, EBITDA TV.com, and you can find the written blog version of this video. All right, thanks everyone. Bye.